Here again with Smart System. In last lesson, we introduced the concept of position sizing, an important yet often overlooked aspect of trading and money management. In today's lesson, we're going to begin to look at some of the different strategies that traders use to determine their position size, so you can hopefully integrate some of these into your own trading and increase your chances for success. So let's get started. As we discussed briefly in last lesson, many traders make the mistake of choosing an arbitrary number such as one contract or 100 shares of a stock to trade when they first enter the market. In addition to the fact that this doesn't consider the amount of capital a trader has at his or her disposal, it also doesn't take into account the fact that the dollar value, as well as the volatility characteristics of one contract or 100 shares of stock or any standardized amount, is going to vary greatly like a poker player who bets the same amount on every hand. This also does not allow trader the flexibility to trade bigger on trades with a higher probability of success and smaller on trades with a lower probability of success. So let's take a quick example here. Let's say there's a trader who has trading capital of $10,000, and this trader buys 100 shares of a $20 stock, which fluctuates on average 5% per day. So this is a $2,000 position 100 times 20, which moves $100 per day. The 5% of that 2,000 on average. This represents a 1% daily account fluctuation on average. As a result of this purchase here, now let's say the same trader buys 100 shares of a $30 stock, which fluctuates 2% per day. This is a $3,000 position, so a bigger position, but a position that only moves $60 per day, in relation to the smaller position that the trader took with the first stock. But because of the increased or the greater volatility with that stock, 5% versus 2% here, he's moving $100 on average of his account based on that first stock, and only 60 on average of his account based on the second stock. So you can see here that this only represents 1.6% daily account fluctuation on average. So you've got between these two stocks, you've got 1.6 daily account fluctuate once, 1.6% daily account fluctuation on average. But the first stock accounting for much larger percentage of that, 1.6% daily fluctuations, and most traders wouldn't even consider that, or most, they would probably consider the $3,000 position being the larger position in the account. And when you look at it from a volatility standpoint, you can see here that it's actually the $2,000 position that is putting more of the account at risk, and also has a greater chance on the flip side of that for potential profit based on the average volatility there. So with this in mind, the next level of sophistication up from that, of just picking an arbitrary number, such as one contractor is trading a standard size, such as one contractor 100 shares of stock, for every certain fixed amount of money. So an example here, a trader starts with $10,000 is very good, and is able to trade that up to $20,000, trading one contract. So he trades one contract on his $10,000, and then when he reaches 20,000, he begins to trade two contracts. So basically the trader strategy here is, he's gonna trade one contract or 100 shares of stock, or whatever it may be, for every $10,000 in his account. Now, while this is better or more rational than the arbitrary example that we looked at in our last slide, as Dr. Van Thorpe points out in his book, Trade Your Way to Financial Freedom, there's several distinct disadvantages using this method. First disadvantage is what we've already looked at, is that not all investments or not all financial instruments, and like we looked at 100 shares of a $10 stock, which moves 5% a day, is not gonna be the same as trading 100 shares of a $10 stock that moves 1% a day. Now similar to that is different stocks obviously have different values. So $100 of 100 shares of a $50 stock is going to be a lot more than 100 shares of a $10 stock, and similarly different futures contracts have different dollar values. So one contract of corn is maybe worth more than one contract of oil, or whatever it may be. Second is, it doesn't allow you to increase your exposure rapidly with small amounts of money. So one of the things that we're going to look at in coming lessons is The concept of when you want to increase your position size as the position moves in your favor, and this method does not allow you to do that. And number 3 is you're always going to take a position, even when the risk is too high, so you aren't factoring in some of the things that we've looked at in previous lessons. With this model, you're always going to take a position, and on top of that, you're always going to take the same size position, regardless of what the probability of success of that trade is, so it doesn't allow you to decrease your trade size when the probability of success is lower, and increase your trade size when the probability of success is higher. So as you can hopefully see from this information, while the fixed position size per dollar amount is better than simply picking a number out of thin air, there are many disadvantages to this method. And next lesson, we're going to begin to look at some of the different ways of overcoming these disadvantages, starting with a discussion of the martingale and anti-martingale position sizing strategy. So we hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comment section. And good luck with your trading. Have a great day.